Welcome to Spidell's California Minute. I'm your host, Catherine Zidane. This week we're covering changes to California's pass-through entity elective tax following the passage of SB 132. Take a deep dive into California tax issues like conformity, residency, community property, and apportionment at Spidell's Critical California Tax Issues webinar on August 27th. See a full list of topics and register at caltax.com under webinars. The governor signed SB 132, which extends the availability of the California pass-through entity tax election for an additional 5 years with modifications. This means that qualified pass-through entities will be able to make the election during the 2026 through 2031 tax years. For taxable years prior to 2026, an entity is prohibited from making the election for the tax year if it fails to pay by June 15th of the current tax year the greater of $1,000 or 50% of the amount of the pass-through entity tax due for the prior year. This has resulted in many entities being unable to make the election if they're even a day late or literally $1 short of these requirements. As a result of changes made by SB 132, this will no longer be the case, effective for the 2026 through 2031 taxable years. Beginning with the 2026 tax year, pass-through entities will still be able to make a pass-through entity tax election, even if they don't timely meet the June 15th prepayment requirement. This relief is not available for the 2025 taxable year if the taxpayer failed to comply with the prepayment requirement by June 15th, 2025. The ability to make the election even if the June 15th requirements are not met comes at a cost. If the June 15th prepayment is made late or underpaid, the credit that the individual, trust, estate, or qualified single-member LLC owners can claim will be reduced by 12.5% of the amount underpaid by the June 15th prepayment due date. For example, if a partnership with two 50% individual partners underpays its June 15th prepayment for the 2026 tax year by $20,000, the $10,000 credit that each partner would be entitled to claim on their 2026 return would be reduced by $1,250. In effect, the 12.5% reduction of the credit acts like a late payment penalty imposed directly against the owners. The bill also clarifies when the entity's owners that are eligible to claim the pass-through entity elective tax credit can claim the credit for a fiscal year entity that files its return for its taxable year beginning on or after January 1st, 2025 and before January 1st, 2026. These owners should claim the credit on their 2026 taxable year return for calendar year taxpayers. Similar to the pass-through entity tax provisions that were in effect during the 2021 through 2025 tax years, the availability of the election for the 2026 through 2031 tax years is dependent on the IRC Section 164, subsection B SALT deduction limitation remaining in place, regardless of the limitation amount. The fact that the maximum SALT deduction has increased from $10,000 to $40,000 or $5,000 and $20,000 for married filing separate taxpayers does not impact the availability of the California pass-through entity tax. If IRC Section 164, subsection B is repealed and a full SALT deduction is allowed on the federal return, California's pass-through entity tax would be repealed for taxable years beginning on or after January 1st of the year in which the federal SALT limitation is repealed. But even if the pass-through entity tax is repealed, the 5-year carryover of unused pass-through entity elective tax credits would still be available, meaning that carryover credits from taxable years prior to the repeal would still be available for the balance of the 5-year carryover period. Stay up to date with California tax law changes with a subscription to Spidell's California Tax Letter. You can get details and download a sample issue at caltax.com under Publications. That's all for this week. Join us next time for another episode of Spidell's California Minute.